Section 7:1 Introduction to Modern Portfolio Theory, Extensions and Criticisms of MPT. 7.1 Extensions of MPT. Modern Portfolio Theory, MPT, has evolved over time to incorporate various extensions and enhancements, including the inclusion of alternative assets and the development of factor-based models. These extensions aim to enhance the risk-return characteristics of portfolios and provide more sophisticated investment strategies. Here are some key extensions of MPT. Alternative assets. MPT traditionally focused on traditional asset classes like stocks and bonds. However, alternative assets, such as real estate, commodities, private equity, hedge funds, and infrastructure, have gained recognition as potential portfolio diversifiers. Including alternative assets in a portfolio can provide additional sources of return and risk diversification beyond traditional asset classes. Alternative assets have unique risk and return characteristics that may be less correlated with traditional assets, allowing for further portfolio diversification. Factor-based models. Factor-based investing has gained popularity as an extension of MPT. Factors represent specific characteristics or attributes that are believed to drive asset returns. Common factors include value, size, momentum, quality, and low volatility. Factor-based models use these factors to construct portfolios that aim to capture the excess returns associated with specific factors. By incorporating factor-based models into portfolio construction, investors can enhance risk-adjusted returns and potentially improve diversification. Multi-asset strategies. MPT typically focused on individual assets or asset classes. However, multi-asset strategies aim to capture the benefits of diversification across different asset classes, regions, and investment styles. These strategies consider the correlations and interactions between various asset classes to construct portfolios that optimize risk and return. Multi-asset strategies may involve dynamic asset allocation, tactical asset allocation, or risk parity approaches. Risk parity. Risk parity is an alternative approach to portfolio construction that focuses on allocating risk equally across different asset classes. Rather than allocating based on market value or capitalization, risk parity portfolios allocate based on the risk contribution of each asset class. The goal is to balance the risk exposure across asset classes, taking into account the historical volatilities and correlations of the assets. Risk parity portfolios aim to provide a more balanced risk profile and potentially enhance diversification. Tail risk hedging. MPT traditionally assumed that asset returns follow a normal distribution, but in reality, financial markets exhibit occasional extreme events or tail risks. Tail risk hedging strategies aim to protect portfolios from severe market downturns or market crashes. These strategies use derivatives or other hedging instruments to provide downside protection during extreme market conditions. By incorporating tail risk hedging strategies, investors can potentially reduce the impact of extreme events on portfolio performance. Goal-based investing. MPT primarily focuses on the optimization of risk and return. However, goal-based investing takes a more holistic approach by considering investors' specific goals and objectives. It involves constructing portfolios that align with individual investor goals, such as retirement income, education funding, or wealth preservation. Goal-based investing considers factors like time horizon, liquidity needs, and risk tolerance to develop customized investment strategies. These extensions of MPT provide investors with additional tools and strategies to optimize portfolio construction, enhance risk management, and align investments with specific objectives. It is important to note that implementing these extensions may require additional expertise, data, and research. Consulting with investment professionals or financial advisors who specialize in alternative investments, factor-based models, or multi-asset strategies can help navigate these complexities and tailor investment approaches to individual circumstances and goals. Behavioral finance is a field of study that explores how psychological and cognitive biases influence investor behavior and decision-making. It challenges the assumptions of rationality and market efficiency upon which modern portfolio theory, MPT, is based. The impact of behavioral finance on MPT can be seen in the following ways. Investor biases. Behavioral finance identifies various cognitive biases that affect investor decision-making, such as overconfidence, loss aversion, herding behavior, and anchoring. These biases can lead investors to deviate from the rational decision-making assumptions of MPT, resulting in suboptimal investment choices and potentially impacting portfolio construction. Market inefficiencies. Behavioral finance recognizes that financial markets are not always efficient and that prices can deviate from their fundamental values due to investor sentiment and irrational behavior. These market inefficiencies challenge the efficient market hypothesis underlying MPT, which assumes that all relevant information is quickly and accurately reflected in asset prices. Market anomalies. Behavioral finance research has identified various market anomalies that cannot be explained by traditional finance theories. Examples include the momentum effect, where assets that have performed well in the past tend to continue outperforming, and the value effect, where undervalued assets tend to outperform over time. These anomalies suggest that market prices are influenced by investor behavior and sentiment, rather than solely by rational expectations and efficient markets. Prospect theory. Prospect theory, a key concept in behavioral finance, suggests that individuals evaluate gains and losses differently. It posits that individuals are more sensitive to losses than to gains and are prone to making decisions based on reference points or framing effects. Prospect theory challenges the traditional utility theory assumption of MPT, which assumes that investors make decisions solely based on maximizing expected utility. Investor sentiment. Behavioral finance acknowledges the role of investor sentiment in driving market trends and asset prices. Investor sentiment refers to the collective mood or emotions of market participants, which can influence their buying and selling decisions. This sentiment-driven behavior can result in market booms and busts, causing deviations from the efficient market assumptions of MPT. Incorporating insights from behavioral finance into MPT can help investors better understand and account for the behavioral biases and market dynamics that influence investment decisions. This integration can lead to more realistic models and strategies that consider the limitations of human behavior and market irrationality. Researchers and practitioners have developed behavioral portfolio theory and behavioral asset pricing models as extensions of MPT to address these behavioral aspects. By recognizing the impact of behavioral biases, market inefficiencies, and sentiment, investors can potentially make more informed investment decisions and adjust portfolio construction and risk management strategies accordingly. This may involve techniques such as incorporating risk controls to mitigate behavioral biases, implementing rules-based strategies, or considering qualitative factors alongside quantitative analysis. It's important to note that behavioral finance is a relatively new and evolving field, and its integration with MPT is an ongoing area of research. Applying behavioral insights to investment decision-making requires a nuanced understanding of investor behavior and the ability to strike a balance between rational analysis and behavioral considerations. Consulting with investment professionals who are well-versed in behavioral finance can help navigate these complexities and make informed investment decisions.